I was poking around on YouTube this afternoon and boom, this video hit me in one of those related video feeds like what you see in the sidebar on YouTube. Market crash begins, how to prepare. Oh my gosh, the market is crashing, right? Didn't you see the headlines last week? It was down 2, 3, 4, 5%. I don't know. I know the market was down last week, but I really don't follow it close enough to know exactly what percentage it was down. But it was down enough to get people feeling like there's a market crash coming on. And this YouTuber here, Annoys, I don't know if I'm pronouncing that correctly, but he's obviously got a lot of subscribers, posted a video right here, this video, Market Crash Begins, How to Prepare, and he published this yesterday, and it's got 297,567 views. Clearly, a lot of people are interested in it. And this stuff just freaking annoys me. I'm going to explain why, okay? So even though the market was down a few percent last week, today it is back on the rebound. Right now, let me check on my app. The S&P 500 is up 2.04% today, and these are close prices. It's the end of the day. Market is closed now. And the global 80-20 portfolio is up 1.47%. So I guess maybe we should just call off this market crash he's talking about here. First and foremost, market crash predictions are usually just plain out freaking wrong. If you do some Googling, you will find market crash predictions every single day of the year. And you can go back 10 years to the day when we started rebounding from the last crash and find market crash predictions. But they've all been wrong. Yes, some people do get these market crash predictions right, but these are typically the people that are crying market crash every single day. And if they weren't in the market, or if they're crying market crash prediction, they're sitting on the sidelines, they're keeping their cash out of the market. That's what I'm trying to say. So these people that cry market crash predictions every day, if you listen to them, well, you would be keeping your money out of the market. Right? So you're going to be missing out on all the upside. And I don't know exactly what the statistics are, but I believe it's something like 8 out of 10 years the market goes up. And we know that over a long term, the stock market goes up. So if you're always sitting on the sidelines, you are not participating in the market returns. Right? That's why you can't be obsessed about market crashes. Historically, going back hundreds of years, market beta is positive. Yes, the market has crashes, but it ultimately comes back up. Now, granted, I know you still might be afraid of market crashes, so I'm going to talk a little bit about what to do here if that's what you are afraid of, right? So we've established that market beta is positive, and market beta means do nothing. Buy and hold, market cap weighted index. Market beta is positive, right? But now what if you're still afraid of the market crashing? Well, the time to prepare is not when Andre Zik publishes a video here. The time to prepare, for the crash that may happen in 5 years is now, right? You got to adapt your whole portfolio to it. And there's two ways that I see that you can fundamentally do that rather than relying on these videos here. The first way is going with a defensive portfolio. So this is going to be your blue chip stocks that have high quality fundamentals behind them. And you can buy ETFs, QUAL, right, is a quality ETF of equities, right? So you can start by buying those defensive sectors like utilities. Drawing a blank here. Utilities is probably the most defensive, and then consumer staples, right? And investing in those, or simply investing in quality stocks that have high quality fundamentals. They have low debt, high return on assets, high profit margins. Okay, when you invest in those stocks fundamentally have not minimal drawdowns, but have less of a downside potential than just investing in market cap beta. But again, some of your upside potential might be capped with that as well. The other way, and my favorite way, is quantitative trend following. Okay, and this is a form of tactical asset allocation. In this video, I cover, a method of quantitative trend following using simple moving averages. This is personally how I handle most of my invested portfolio. And in this video, I cover, statistically, how quantitative trend following helps you identify the bull markets, the bear markets, and avoid black swans. So if you're interested in that, go read this, or go read. I'm on YouTube here. Go watch this video. Yeah. So bottom line with this actual video that I wanted to make is These types of headlines annoy me, and quite frankly, you should not follow them. If you are concerned about a market crash coming up or want to have protection when there is a market crash, stop watching these videos, don't worry about it, and position your portfolio accordingly so that you're protected in the event of a market crash. And historically, what that means is trading a few percentage points of upside for a few percentage points of downside protection.